Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. Let's talk about investments that I will call private equity from here on out, but it is known by many names. I will cover what they are, the pros and the cons of the asset class, how to purchase good investments, and what to avoid. Generally, you can think of private equity as an alternative investment to stocks and bonds that we've been talking about so far. Synonyms are venture capital, hedge funds, mezzanine capital, venture capital, growth capital, private investment, buyout, angel investing, and alternative investments. Generally speaking, private equity are small companies that don't want to trade on a public stock market because of the expense of going public or because they would have to make their accounting public, which could help their competitors. These companies still need money, however, to grow or run their business, and so that's when they come to private investors. I have included some examples of what I own, but I'm not advocating any of the following. In fact, most of them have been lukewarm success at best. First is Clear Sky, which runs car washes and apartment buildings in the US. There's Centurion, which runs apartment buildings in Canada. Equicapita, which acquires small companies in a wide cross-section of industries. Then there's Nationwide Self-Storage, which builds self-storage buildings and in Vancouver is using a small 5x5 unit as a unique business model for condo dwellers. Yorkton is a land developer which rezones and consolidates land and then resells it to a developer or actually puts up the buildings. And finally, there's Store West, which builds self-storage and car washes and runs them. Other examples of private equity would be mezzanine capital, which are debt from or equity in a company which is secured by that company's assets, but usually subordinated to other equity and debts. The financing is to help a company temporarily, usually in a transition. Angel investing helps startups get off the ground, usually for a hefty share in the company to offset the risk, and allowing a large return if the company succeeds. The word angel may not be that accurate, but one could argue that the company wouldn't get off the ground at all without the money. Buyout capital companies purchase other companies, whether those that were originally private or public, and engage in some financial action like splitting the company up, taking it public, taking it private, or combining it with another company, etc. When looking at private equity, some general statements can be made. The pros. The main benefits are diversification from public markets. That is, private equity doesn't behave the same as public markets because they are not traded every day, and investors can't sell whenever something happens in the world that scares them. For example, Russia invades the Ukraine, even if that doesn't affect us in Canada. You can see in comparing Centurion, which runs apartment buildings in Canada, to the XIU Exchange Traded Fund, which represents Toronto Stock Exchange, that Centurion behaves differently than the stock market, so is great for diversification. Private equity can have some great returns with monthly or quarterly cash flows which perhaps have no tax implication, and then you have a capital gain when you get your money back. The tax treatment can be either interest, capital gain, or return of capital, meaning no taxation. Most private equity companies are TFSA or RRSP eligible and are based in Canada, so you don't have to do US taxes. The cons are that you could lose all your money, and the court process would take years before you are told that you lost all your money. There's usually minimums, actually always. It could be as low as $5,000 or as high as $50,000 or beyond that. They are not liquid. It's hard to get out, or you can only get out on specific dates, or you have to pay a penalty, or only a limited amount can leave the company every year. You have to see your money as being gone for 3 to 5 years, depending on the investment. There's no necessary visibility nor necessary disclosures. Some funds don't give you any information, others will send you monthly emails with pictures. But generally, the first time you see that there's a problem is when you don't get the monthly payment in your bank account. If something goes wrong, you generally have no recourse other than lawyers. They use a salesperson to sell you the investments, who gets a commission from the private equity company. They're usually real estate related, so it somewhat limits the scope of the investments, but not always. And again, things can go very badly, and you'll never see it coming due to the lack of disclosure. The sales company may review the investments before they sell them to you to prevent outright fraud, but they do need to sell you something, so they're not going to be horribly careful in order to filter things out because they make money off of the commissions for what they sell you. Private equity is considered the riskiest of all investments because regulations are less for those companies than for publicly traded companies. And some are reserved for eligible or accredited investors, which means different things in different provinces. And we'll talk about that in a minute. Most of the private equity investments you can buy without being eligible or accredited, but the person selling it to you will give you a KYC, a know your client, to ensure the private equity isn't too much of your portfolio for your risk profile, since the private equity can be quite risky and you want to limit the amount of risk you have in your portfolio depending on your risk profile. So that's why you get the KYC. Going back to the eligible and accredited investors, let me say that eligible is a lower bar than the accredited investors. But let's just for fun, let's define what eligible and accredited investors are. Please note that these can vary by province, and each company may define these slightly differently as well in their contract with the investor. So, an eligible investor means a person whose net assets, alone or with a spouse, in the case of an individual, exceed $400,000. Also, net income before taxes needs to exceed $75,000 individually or $125,000 with a spouse in each of the 2 most recent calendar years, and who reasonably expects to exceed that income level in the current calendar year as well. There can be other criteria, but the money ones are the ones that most of us will qualify on. An accredited investor is a higher bar, and it's somebody who, either alone or with a spouse, beneficially owns, directly or indirectly, financial assets, which excludes the individual's home, having in aggregate realizable value that before taxes, but net of any related liabilities, in excess of $1 million. And it's also an individual whose net income before taxes exceeds $200,000 in each of the 2 most recent calendar years, or whose net income before taxes combined with his or her spouse exceeds $300,000 in the most 2 recent calendar years, who in either case reasonably expects to exceed that net income level in the current calendar year. So let's take an example of a private equity company and how their business model works. I'm going to use Nationwide Self-Storage. So they use my investment to buy land, they rezone it, they build the self-storage building, they get the customers for the self-storage, they refinance, they pay me an 8.5% going back to the time that I invested the money, and then they start paying me monthly for an 8.5 annualized return rate. This is a return of capital, and so it's not taxable. They're giving me my own money back. But this lowers the adjusted cost base, that is what I paid in. The company will then stabilize the building, sell to an investor in about 3 to 5 years, and give us our money back. Upon which time we're charged capital gains on the difference between what they sold it for and the adjusted cost base. They ran into some problems in Vancouver, where City Hall apparently takes much longer than expected to rezone and give building permits. And so, despite having invested close to 4 years ago, I still haven't seen any money yet. So things can go wrong, or they can just get delayed, and that seems to be a common theme. So how do you find a good private equity opportunity? So first of all, do your own research before and after the sales presentation. Read the prospectus, also known as the offering memorandum, very carefully. Make sure you understand the business model and are happy with it. However, trying to second guess the person running the private equity company is pointless. So you generally have to make a go, no go decision. You can't tell the CEO how to run their business because they've been doing it for many years. You can get access to the high ups in the organization, so ask a lot of questions, both at the presentation or after. Try that with a publicly traded company. If you're going through a sales company, so for example, Yorkton has its own salespeople, but others go through a sales company. Uh, See what research they did before they put it on the market and try to sell it to you. Real estate maintains some value, so a real estate based private equity company may be safer. But if something goes wrong and lawyers get involved, you still won't get all of your money back. Companies that pay out a lot may need to because they're risky and they need to compensate investors for the risk. But they may have a tough time making the payments and then they get in trouble. So try to find companies that have a long history of making money and not losing money for investors. Try to find companies that have audited financial statements and make sure that the claims made by the salespeople are verified and sound reasonable. As I have mentioned earlier, the time frames that I was given by various salespeople were the most optimistic ever and really need to be taken with a grain of salt. You may not get your money back all that quickly. And lastly, try to find investments that have a good basic model that makes sense. Running apartment buildings, for example. At a high level, everybody needs to live somewhere, so it sounds like a good investment at the basic level. So some potentially bad private equity deals could involve not being covered by real estate, one where you don't understand the business model, it sounds too good to be true, the company has no history or no history of profit, or wants my money for some future investment that is to be determined later and they get to determine it. Lastly, if they break any of the suggestions that I had made earlier for a good investment, that would also be a questionable investment. I've never run into any outright fraud because the sales company did have a look through, and I'm hoping that they excluded outright fraud at the company level. But there have been investments that I heard of where the CEO or the CFO was doing some extracurricular activities. And that's really something that's unpreventable other than by the auditors. So to summarize, private equity is a potentially profitable yet risky investment that is potentially hard to get out of, but can also offer good diversification from residential real estate or volatile stocks or bonds. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.